So welcome everyone to our speaker series this week, Thursday, May 25th. I'm happy to be joined today by Brad Smith. Brad joins us from Janus. Brad, welcome.
Thank you.
Brad, so you're in the fixed income strategy group there at Janus, which is a great time to have you, I think, on. We actually have one of your funds in our IMAP strategy, so I have particular a sort of desire here to speak to you, so it's going to be great. But before we get into some of the specifics, why don't you start us off with your sort of macro outlook? What's your 30,000-foot view on, everything that's worrying markets right now, whether it be the Fed rate cycle, the U.S. economy, the global economy, the debt ceiling? Let's throw it all together, lump it all together, and get as much as we can from you on that.
Yeah, absolutely. I mean, I think myself, like everybody else, is a little confused about what's going on because it's kind of a tale of two cities, right? It's been a very interesting time. We've come from a period of breakout inflation that has caused the Fed to have to aggressively raise rates, and now we're likely to a place where the Fed is sort of on pause because it views rates as sufficiently restrictive. But now we have to sort of wait and see what the impacts of those long and variable lags are on this relatively persistent inflation. We've also sort of within that, and the Fed's aggressive hiking cycle have created, three of the largest bank failures in modern history without, too much material spillover. And so there's a lot of question about how that's going to emanate. And we've done a lot of work to think about what the sort of impact to the broader economy is going to be from that particular crisis. We do think that there's further reverberations of that issue to continue. At the same time, you're at a place where leading economic indicators are flashing recession. And then now we have the debt ceiling impasse that stands right on the horizon. That's greatly unnerving markets. So, the setup ostensibly seems not that great, but at the same time, we're at a place where, we just had, corporate earnings season. Corporate earnings remain quite resilient, right? Mm-hmm. We're at a place where nominal growth can actually shield a lot of this sort of real growth slowing in corporate earnings. And corporate health can be quite strong. Earnings were solid, guidance was solid. We've been talking about this idea at the beginning of the year that we were going to see 190 EPS on the S&P earnings for this year, and that those estimates are moving higher now rather than lower. So it's been a relatively strong, resilient corporate environment. And then you also have this situation where the labor markets are extremely tight. I am personally of the view that this is a structural issue that emerged prior to COVID, right? We already had a declining participation rate in the labor markets. And then COVID served to accelerate that and really take that 55 plus cohort out of the labor market. And so today we sit at a place where we're on $4 million jobs short of what we really need in the economy. And so we're sitting at a place where unemployment is actually going down, despite the consensus viewing a recession as the likely outcome here. And so I do think that labor situation is what needs to crack to emanate a recession, but also has a lot of resiliency here because of the structural issues behind the labor market. You take all that together, and then you add in two other components, which are, this is probably, as we describe it, the most anticipated recession in history, right?
Absolutely.
It's
people have been talking about a recession since early last year.
Exactly. And it's almost becoming the boy who cried wolf, because, since early last year, everybody's been worried about it. We've already had the kind of tantrums in the market that have sort of repriced things, and everybody's gotten more on sides. And while, positioning has gotten more optimistic, it's certainly not full bore from that perspective. And so I bring that to valuations and I say, I do think that we are likely to have a recession. I wouldn't put it at 100%. I wouldn't even probably put it at 75%, but somewhere in the 65% chance over the next kind of 9-month period. I do think that we will enter recession, probably a moderate recession. The Fed staff just recently has predicted a recession. It is consensus, but the counterpoint to that is valuations aren't really reflecting this, right? If we go through the markets, U.S. investment grade, 140 spread above treasuries on the U.S. investment grade market. Typically in a recession, you see that at 200 or 220, if not, times of COVID, kind of 350. High yield markets at 450 today spread. That is certainly not reflecting a recession. Previous recycles, we've seen north of 800, even 1,000 in 2008. Right. And today we're sitting at 450. Now, I do think there's nuances in the high yield market that make it a higher quality market today. There's technical factors that make it a shrinking market that mean probably in this mild recession, we're looking at 600 to 650, but that's a lot of downside. And then you take it to equity markets, 18.5 times forward PE multiples are not necessarily extremely rich, but if you look at a time prior to QE, which we're in a period of QT today, the average multiple was 16.5 times. So we are looking quite optimistic on equity markets there. So I think that's kind of like the 10,000 foot view. And then you bring that into how you sort of think about positioning and you're like, you know what? I don't see a recession imminently on the horizon. Valuations have reflected some of this, but not a lot of it. I don't want to stick my neck out and take a lot of risk here. I want to core up my portfolio, particularly in places like the investment grade market. There's not a lot of dispersion. So it doesn't take a lot to go into a higher quality name. You're not giving up that much spread, but you're going to save yourself a significant amount of downside when we do, and if we do get to the end of the cycle. So that's kind of broadly how we're thinking about the world here. Not, modestly underweight risk, not too underweight risk, certainly aggressively monitoring the market for particularly the change in the job market is that's probably what emanates the recession. But more importantly, something else could break.
Okay, and let's talk about, because there's been a pretty strong repricing this week, really, in the Fed funds futures and future rate expectations. I mean, we started the week, and towards the end of last week, basically the market was assigning a 0% chance that the Fed raises the rate at the next meeting in June. As we sit here today, I'm looking at it and it's sitting around 49%. So the market's basically saying that there's a 50-50 chance that the Fed raises the rate again by 25 basis points at the June meeting. That figures up to 45.6 if you look at the July meeting. So collectively, the markets, probably if you put those probabilities together, not that you could do that straightforwardly, but if you could, the market's telling you that they're now thinking that the Fed's going to have to raise rates perhaps one more time. On the opposite end of the spectrum, it's really the market has removed a bunch of rate cuts that were previously priced in as well. The forward curves are also showing the Fed funds rate roughly at 5% by the end of the year. That figure was as low as 3.9 not too long ago. What's your view there, specifically because you're obviously in the fixed income space, so duration is an important facet of your investment process. Where do you guys stand, and how are you positioned for Fed monetary policy going forward?
Yeah, I mean, you bring up a really interesting point about what happened since the last FOMC meeting, right? The last FOMC meeting, Powell took that or the market took Powell's commentary, particularly in the press release and then the presser, as it's a pause light with the optionality to raise rates, but really sort of talking towards a pause, even mentioning, hey, I believe that we are potentially at a sufficiently restrictive level. If you look at forward 1-year forward inflation at 3%, a Fed policy rate at 5.25%, have a real Fed funds rate of around 2%. That has been what the Fed speak has largely talked about as a restrictive territory, 1.5% to 2% real Fed funds funds rate on a forward basis. So the market really took that as a pause. But subsequently to that, we've had a lot of Fed speak out, somewhat balanced, but really doing what I think Powell wanted to do was to take away that 0% chance of a hike, to leave open the possibility for data dependency, and then to really do what he's been trying to do for a long time and knew had to happen, was take out, as you said, those cuts that have been priced into the forwards market for quite some time now. We saw almost 100 basis points of cuts taken out from when we were at the peak of the SIVB crisis to today. So that's a very material repricing and much more closer to what the likely path is. But that being said, I mean, the Fed is very clearly against the wall here. Powell is very clearly still in his Volcker moment, in the sense that he is not going to cut rates until we have a glide path to 2%. And that means hold here and hold for longer. The average Fed pause is 7 months. And in this case, it could be longer if inflation remains resilient. And I bring that back to the discussion around the labor market. The labor market is very tight, and the Fed is extremely focused on wage inflation. And if the labor market remains tight because of those structural forces, because of strong nominal growth, well, it's unlikely that we're going to see a large easing in the labor market. And so that likely means the Fed remains on hold for quite some time. Now, with all that being said, if you look at history tells you when you get to the Fed pause, relatively soon after that, you want to be long duration. I actually have a chart in the pack that I could show later, but every single time in the last 40 years that you've gotten to a Fed pause, you've seen subsequently a very rapid decline in Treasury rates. So strategically, we think that it is a interesting time to be long duration, but tactically, I think there is a little bit more to go in terms of upward pressure on rates, and that's for two reasons. One, the market got ahead of the Fed. One of the charts that we look at and think about a lot is the spread between the Fed funds rate and the 2-year. That got down to kind of minus 120 basis points. That is as stretched as it has ever been. And so the market was sort of pricing in too much cuts from our perspective. And then from there, sorry, I lost my train of thought.
You're talking about the spread between the Fed funds and the 2-year bond.
Yeah. So, so tactically, I think there's a bit more to go from that perspective. The market got ahead of itself. Typically, you see that type of spread later on in a pause, 6 to 8 months into a pause is when you start to see that, as the market sort of front runs a series of cuts. And then two, I do think that the debt ceiling debate actually, in a sort of counterintuitive, well, not in a counterintuitive, but actually as an upward pressure on rates, largely because you have to go, the Treasury, once we get the debt ceiling solved, it's actually after the debt ceiling, once we get the debt ceiling solved, the Treasury is going to have to go replenish its coffers at the TGA by almost $1 trillion. And that's going to cause a large, massive amount of bill issuance that's subsequently going to get refinanced out the curve. And that's going to create a lot of supply. At the same time, we're moving from a period where we've had increasing liquidity in the market because of the TGA drawdown and the Fed's extraordinary measures to counteract the central bank, the banking crisis. We've actually injected almost $1 trillion of liquidity into the market this year, counterintuitively to quantitative tightening. But as we move into a solution for the debt ceiling, you're actually going to be drawing liquidity out of the system as you replenish the TGA. QT takes hold. The banks aren't relying on the extraordinary measures as much from the Fed. That's going to be liquidity draining. That means less money out there to buy treasuries. And so I think tactically here, treasuries have a little bit more to go, but strategically, you want to be thinking about fixed incomes back. You want to be thinking about putting duration back in your portfolio.
So that's on the rate side. How about credit? You mentioned the spreads. So the spreads, certainly not in high yield, but not even in investment grade, are really reflecting what it sounds to me like you're saying are the appropriate recessionary risks. So how are you mitigating some of the risk on the credit side rather than the rate side? Because on the rate side, it sounds like you're sort of cautiously moving long duration or would be soon. But how about the credit side?
Yeah, exactly. Cautiously moving long duration here with a tactically as we see rates move a little bit higher, we're probably going to leg
Would you
in.
agree that if the 10-year, let's say, were to hit 4%, that would be a very, very appropriate or attractive level to buy, or do you think it could go higher than that?
The treasury markets always overshoot, but I think that is it's a range that we've already seen tested
Right.
and pushed through. I think that's a very attractive long-term level. I mean, if you think about just, long-term neutral rate of interest at 50 basis points, probably higher today, and inflation a little bit higher today, you could be thinking about a 10-year in the kind of 3 to 3.5% longer term. So if you can buy it at 4% and hold that for a while, that's a pretty interesting level to buy for sure. So yes, answer to that question. In terms of credit spreads, right, today on investment grade, about 140 over treasuries for about 7 years of duration. We would view that as not fully reflecting the risk of a recession today. We did see it this year as tight as 115, but as the SIVB banking crisis played out, it started to push spreads wider. Primarily in the financial sector, but it's important to understand that the investment grade world has a higher exposure to financials than sort of the S&P, I think, is at 10%. And in the investment grade world, it's about 35% exposed to banking. So a much bigger exposure there. That brought out the spreads primarily through the financials side of spreads. Now at 140, is that reflecting a recession? Our view is no. As I mentioned in previous recessions, we've seen anywhere north of 220 for a mild recession or 350 of the likes for something like COVID. A mild recession with consensus already sort of expecting a recession, I think you can buy with a lot of certainty in the kind of 175 area, save for an unforeseen breaking of something. And so at 140, certainly not reflecting that, but we think much more so than the high yield market, where the high yield market at 450 today, could have material downside. So you're talking about, let's say we go into recession, previous recessions in the likes north of 800. In 2008, we're talking more north of 1200 in terms of spread. And then you have to factor in the fact that you also are much more exposed in the high yield market to defaults, right? So the default rate today in the high yield market is about 1.4%. In the year 2000, when the tech bubble burst, we were talking about 6%. And I think that's more like the type of recession we're talking about, not something like 08 or COVID or something like that. But that's a significant increase in the default rate. Plus, you have spreads go wider. So high yield, in our view, is not fully compensating you for that risk of recession. I'll caveat that by saying it's important to understand that the high yield market has drastically improved in terms of quality than what we have seen in over the past sort of 10 years. Part of that is because energy is a huge part of the high yield market, and that has drastically improved from the years of 2016 when we were over levered and oil was falling. Today, with the support of sort of the war in Ukraine and high oil prices, restructured balance sheets, actually. The oil and gas market and the high yield market is one of the tightest trading sectors. You've also seen a massive amount of companies migrate from lower ratings into the double B bucket. So now today, about 50% of the high yield market is double Bs rather than lower quality. And then you've also had, as recently as a couple of weeks ago, some of the larger players in the high yield market migrate to investment grade. So a name like Oxy Petroleum, which was one of the largest, I think it was the number 4 issuer in terms of the high yield index, migrated to investment grade. And we've seen a large number of those, over 100 million in terms of nominal value of these names that have sort of migrated in that direction. And so that sort of is a view to say the high yield market's shrinking because those are exiting and there's not a lot of issuance and it's higher quality today. So if we have a regular way recession, -0.5% real GDP growth, you might be talking about 600 to 650 as an attractive entry point for high yield.
Excellent. Yeah, we actually had an investment committee today, and we're probably going to be reducing our high yield exposure precisely because some of these factors that you mentioned. Brad, let's go quickly and let's talk about some funds before we open it up to questions from the audience. And I do want to remind everyone that if you do have questions for Brad, please put them into the chat. I'd be happy to ask him those. If you want to send them to me directly, I'm happy to take a look at those as well. Brad, let's talk about the Janus Flexible Bond Fund, which is the one that we have in our IMAP strategy. Give us a sort of broad overview of how you guys are positioned there, and what's your view here over the next 6 to 12 months for that portfolio.
Yeah, the flexible bond strategy is we're currently positioned in a place where we're at one of the lower risk profiles that we've sort of ever had in that fund, and it has a lot to do with everything that I've talked about of sort of this worldview of not particularly attractive valuations relative to the amount of risk of a recession that's out there. That being so, our corporate allocation within that fund is one of the lowest it's ever been, particularly because I mentioned we don't view corporate spreads as fully reflecting that recession risk. There are pockets of the market that are much more attractive today and much more reflective of recessionary levels. Things like ABS. The ABS market is a lot closer to recessionary levels than we've seen in the past. Things like CLOs look particularly attractive, and then mortgages are at a place over time they should outperform corporates. They've widened relative to corporates quite significantly, and so there are pockets of attractive opportunity in a multi-sector portfolio that give you the ability to implement attractive security selection and relative value plays without having to stick your neck out and take a significant amount of risk. Then you layer in the duration view. We're not particularly long duration, but I would say we're closer to neutral here with the view of getting longer.
Okay, and finally, my final question for you would be: I've been made aware that you guys over at Janus are launching a fixed maturity vehicle. Basically is sort of a proxy of a bond for end clients. Can you talk a little bit more about that? How is it structured? What's the purpose of it, and how does it fit in some client portfolios?
Yeah, I think it's a really interesting opportunity, a really interesting time to think about a fixed maturity bond fund. We have not launched a product like this before because in the previous 10 years, at the zero bound, in the search for yield, you had to go so down the credit risk spectrum, so far down the credit risk spectrum to access attractive yields that you really were junking up a portfolio, right? And we saw this era of FMBs issued by competitors that would do a barbell strategy of single A bonds and then high yield home builders from China, and took on a lot of risk just to get an attractive yield. Well, with where yields have moved today in both from a treasuries perspective, but also credit spreads on top of that, you can lock in front end yields, particularly front end, which is now, because of the inverted curve, you don't have an upward sloping yield curve in IG corporate credit. You can stick in like the 3.5 year portion of the curve and lock the current yields in for 3.5 years. Why that's important is because, right, it's a very interesting alternative to cash and money market funds today, right? You can lock in around 5.5% in the front end of the IG corporate market versus what you can get in the front end of a money market mutual fund or cash. And, if we do, as we expect, see either the Fed ease because inflation naturally comes down, or we hit a recession where we retest the lower bound, your front end allocation to cash or money market mutual funds is going to move with the Fed funds rate down aggressively, right? I heard the analogy recently that the Fed takes the steps up as it raises rates and then takes the elevator down when it eases, right? It goes down very quickly. And so those attractive yields that you are getting today are going to go away very quickly if and when we do face an easing cycle. So the FMB gives you the opportunity to lock in those yields for a longer period of time without taking much risk, right? It's a primarily investment grade portfolio, a small allocation to high yield, with only our kind of best in class, best and brightest ideas of double Bs, which we view likely to move to investment grade. So a very relatively low risk portfolio of investment grade bonds that allow you to lock in these very attractive sort of peak yields today in a much better way than you can get in a money market mutual fund, which is going to lose that yield. I'll lastly just touch on the structure of an FMB and how it differs from the other funds that we manage, right? So the beauty of a fixed maturity bond fund is that it is basically like a bond. It gives you the benefits of a bond, which are, I know what my coupon is, I know what my income is, and I know at maturity, I'm going to get my principal back. If you buy an open-ended bond fund, our yield changes daily, the principal value changes daily. And yes, those are total return strategies. But especially for somebody who's trying to swap out of a money market mutual fund, it's not as clean of an income source. So with an FMB, it's a fixed date maturity, but it also gives you the diversification of over 100 bonds that are picked by the same team of professional credit analysts that are picking bonds for flexible bond or our US high yield portfolio. So it's a highly curated, diversified portfolio of bonds, but it gives you a known coupon, a fixed yield, and a fixed maturity. And so it gives you a lot more certainty, and it locks in that yield for about 3.5 years. So it's a very unique structure. It gives you the benefits of bonds and a bond portfolio. And it's a very unique time to be able to get that type of attractive locked-in yield without having to take on a material amount of risk.
Okay. Thank you for that, Brad. So I see there's a question here. It says, can you please talk about the leverage on the fund? Is it only currency hedged? I'm assuming is the second part of the question.
Yeah, so the number you see in terms of leverage only reflects the use of derivatives, and the only use of derivatives that we use are for FX and interest rate hedging. This is a global bond fund. It will have euro and US dollar denominated bonds. The reason we do that is because we have a global team of analysts. Some sit in London, some sit here in Denver, and we look to exploit price inefficiencies in the credit markets that can enhance the yield without taking on incremental risk. And therefore, we need to use derivatives to ensure that we can have that fixed coupon, but no credit leverage whatsoever, and no use of CDS or CDX.
Okay. A final question here, Brad, because we are running out of time, is any particular views on Latin American debt, certain country views, get anything particular, either opportunities or risks you want to mention?
Well, I would say this. We have decidedly chosen not to implement much. So the FMB, as an example, we've limited the emerging market exposure to just 5%, and we don't even intend to allocate even that much to emerging markets today. We do think that there are some modest opportunities in emerging market debt today, in higher quality countries like Mexico or Chile. But we don't intend to lean into that very much because, again, you can get such attractive yields in the U.S. investment grade or European investment grade markets without having to sort of step down into Latin American sort of emerging market debt. I think there is a time and a place for that, but just like high yield, I do believe that emerging market spreads have a lot more downside as we move into a sort of a recession emanating in the U.S. that could emanate further around the globe. So our view would be don't allocate significantly to emerging markets. There's a time and a place for that, and it will be down the road.
Excellent. Well, Brad, thank you so much. Unfortunately, we ran out of time, so we need to end our conversation. But thank you once again for joining us and for talking to us about not just your strategy and views, but some of the products that you help manage.
Great. Well, I really appreciate it. And please don't hesitate to reach out if you have any interest in some of the products we talked about today.
Great. Thank you so much. And thank you everyone for joining us. We'll see you next week. Take care, everyone. Bye-bye. Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices,